We've got an incredible deep dive for you today.
Yeah, we really do.
Right, so our mission today is to unpack the May 26, 2026 Global Market Intelligence Report, and we're doing this to help you navigate what is honestly a severely bipolar macroeconomic ecosystem right now.
Bipolar is definitely the right word for it.
Because on the surface, there's all this euphoria, you know? I mean, Q1 AI earnings just surged 15.1%,
Right.
and tech megacaps jumped 14.88%, but that's not the whole story, is it?
No, not at all. I mean, those surface numbers completely mask some deep, deep structural decay underneath. It's a terrifyingly narrow margin for error.
Kind of reminds me of a duck.
A duck.
Yeah, like totally calm on top of the water, but just paddling frantically underneath.
Oh, yeah, that's actually a perfect analogy.
Because, okay, look at oil. Prices just tanked down to $90.76 a barrel. And that's largely because of a potential U.S.-Iran deal over the Strait of Hormuz.
Right, the market is pricing in peace.
But that's my question. If tech is booming and peace is supposedly pricing in, why are investors simultaneously hoarding physical gold at over $4,540 an ounce?
Well, because gold isn't just an inflation hedge anymore. I mean, it's fundamentally evolved. It's now a sovereign risk hedge against global systemic debt.
Oh, wow.
Yeah. So investors are deploying what we call a barbell strategy.
The barbell, right.
Exactly. They're loading up on high beta AI tech on one side of the barbell and stacking gold on the other, because they're absolutely terrified that if those Iran talks fail, 20% of global oil transit just vanishes.
Which would completely annihilate the whole disinflation narrative we've been hearing.
Exactly. It would be gone overnight.
So this barbell desperation, it's essentially causing a massive structural earthquake in digital assets, too.
Yeah, it really is.
Because spot Bitcoin ETFs, they just bled $1.34 billion in just 4 days.
It sounds bad, but the capital isn't actually leaving crypto. It's just ruthlessly rotating.
Rotating to where?
Well, Bitcoin is suddenly behaving like a mature, lower beta portfolio stabilizer now. It's not a hypergrowth asset anymore.
So they're treating it more like a base savings account.
Right. And they're rotating their active capital into layer one networks,
Mm-hmm.
things like Hyperliquid and Solana. They're going there for aggressive staking yields.
Getting paid high interest just to lock up their tokens and secure the network.
Exactly. It's all about finding that aggressive yield now.
But all of this, the gold hoarding, the AI tech boom, the crypto yield hunting, it all ultimately hinges on one wild card, doesn't it?
The central bank. Always.
Right. And just impartially reporting the facts here, we're seeing the new Fed chair, Kevin Warsh, publicly refusing executive branch pressure to lower interest rates.
Yeah, he's vowing absolute independence.
Which is driving this whisper number I keep hearing about, the quiet institutional fear that Warsh might actually execute a surprise 25 basis point hike in Q3.
Yeah, just to crush inflation entirely and prove he won't be pressured. And that exact fear is why the 10-year Treasury yield is hovering at a suffocating 4.70% right now.
So for you listening, you are basically watching a violent collision between AI, corporate efficiency, and geopolitical gravity.
It's an incredibly fragile setup.
It really is. So I want to leave you with one final provocative thought to explore on your own.
Let's hear it.
Bitcoin funding rates have been negative for an unprecedented 74 consecutive days.
That's a massive amount of overhedged short positioning.
Exactly. So ask yourself, if an exogenous shock hits, like, say, a surprisingly dovish Fed data print, could this heavy positioning trigger a massive cascading short squeeze?
That would definitely force everyone to buy back their shorts at the exact same time.
Right. And could that violently propel Bitcoin back above $82,000? It's definitely an angle you'll want to keep a close eye on.